What if I told you that some of the most successful traders are wrong more often than they are right? It sounds like a paradox, but it's true. We're conditioned to believe that success means being right most of the time, whether in school, sports, or life. So, it's natural to assume you must win most of your trades to make money. But here's the truth. Your win rate is one of the least important metrics for long-term profitability. Many legendary traders profit with win rates as low as 30 or 40%. Their secret? Disciplined risk management and the ability to accept small losses as routine. They know the size of your wins and losses matters far more than how often you win. The real goal isn't to be right all the time, but to structure trades so your winners are much bigger than your losers. The best traders focus on risk controls, exit strategies, and staying in the game after losses. In trading, success is about the magnitude of your profits, not the frequency of your wins. New traders are bombarded with ads promising sky-high win rates, 90%, even 95%. This sounds like a guaranteed path to wealth, but it's a dangerous illusion. Chasing a high win rate leads to bad habits, taking profits too early and holding on to losers too long. You end up with many tiny wins, but a single big loss wipes them out. The market doesn't reward you for being right. It rewards you for how much you make when you're right versus how much you lose when you're wrong. A trader with a 90% win rate can still lose money if their losses are much bigger than their wins. Don't fall for the beginner's trap. Focus on risk, not just being right. Professional traders accept uncertainty. They know they can't predict the future. Their edge comes from discipline and a strategy with positive expectancy, not from perfect predictions. Small losses are business expenses, not mistakes. Pros define their risk before entering a trade, using stop losses to cap potential downside. They cut losses quickly and let profits run, using tools like trailing stops to maximize gains. This creates asymmetry. Average winners are much larger than average losers. Being wrong often is fine if your winners are big enough. Pros detach their ego from individual trades and focus on flawless execution of their plan. Losses don't define them, discipline does. By accepting frequent small losses, they avoid emotional swings and stay rational. This psychological resilience is their true edge. Profitable trading boils down to positive expectancy, what you can expect to make on average for every dollar you risk. Win rate alone is meaningless if your losses outweigh your gains. Take Trader A, wins only 40% of the time, but her average win is $300, and her average loss is $100. Over 10 trades, she nets $600 profit. Trader B wins 80% of the time, but his average win is $50, and his average loss is $450. Over 10 trades, he loses $500. The difference? Risk and money management, not prediction. Asymmetric returns, big wins, small losses, are the engine of profitability. You can be wrong often and still come out ahead if your winners are large enough. This is the mathematical foundation of sustainable trading. Don't judge your trading by win rate alone. Focus on the size of your wins and losses. Asymmetric returns, where your potential profit far exceeds your potential loss, are the cornerstone of professional trading. George Soros built his fortune not by being right often, but by making huge gains when he was right and taking small, controlled losses when wrong. Venture capitalists expect most investments to fail, but a single big winner pays for all the losers. Trend-following traders operate the same way. Many small losses, one big win. This approach requires comfort with being wrong and the discipline to stick with the strategy. Small losses are the cost of finding the big winner. A strategy with a 3-to-1 reward-to-risk ratio only needs to win 25% of the time to be profitable. The best traders engineer their trading for asymmetric payoffs, not high win rates. They focus on risk and reward, not prediction. The power of this approach can't be overstated. In trading, you don't need to be right often, you just need to be right big. A low win rate isn't dangerous, a large loss is. Drawdown is the drop from your account's peak to its lowest point, and recovering from big losses is exponentially harder. Lose 10%, you need an 11% gain to recover. Lose 50%, you need a 100% gain. This is why capital preservation is rule number 1. Chasing a high win rate often leads to holding losers too long, risking catastrophic drawdowns. Pros prefer many small losses over one big one. Protecting your account from large drawdowns is your main job. Use stop losses and risk only a small percentage of your capital per trade. Surviving losing streaks keeps you in the game for the winning streaks. Without capital, you can't trade. Make protecting it your highest priority. The greatest traders emphasize risk management over being right. Jesse Livermore said, "The key to big money was not in the thinking, but in the sitting. Letting winners run, not grabbing quick gains." He learned the hard way to cut losses quickly. Paul Tudor Jones starts each day thinking about defense, not offense, and only takes trades with a 5-to-1 reward to risk ratio. George Soros summed it up. "It's not whether you're right or wrong, but how much money you make when you're right, and how much you lose when you're wrong." These legends focus on the size of wins and losses, not win frequency. Their wisdom points to one truth: risk management is everything. The number one rule in trading is simple: preserve your capital. Without capital, you're out of the game. Professionals treat their capital as their most precious asset, not a lottery ticket. The goal isn't to double your account overnight, but to survive long enough for your edge to play out. This means risking only a small percentage, 1 or 2%, on any trade. With this rule, you can endure losing streaks and still recover. Trading is a marathon, not a sprint. The traders who last are disciplined risk managers, not gamblers. Slow, steady growth beats reckless bets every time. Make capital preservation your top priority for a long, successful trading career. Becoming a consistently profitable trader is about shifting your mindset from gambler to risk manager. Forget the myth that a high win rate equals success. Focus on your reward to risk ratio. Define your exits before you enter a trade. Only take trades where the potential reward is at least 2 or 3 times the risk. View losses as business expenses, not failures. Keep losses small and controlled and move on quickly. Protect your capital with discipline and patience. Success comes from executing a positive expectancy model over hundreds of trades, not one big win. Let go of your ego, embrace the math, and manage your risk. That's the simple, powerful truth about winning and trading.